All right, thanks for joining us today for the 1.5 CP credit hour webinar. A little bit of background on myself and our firm. Just spend a quick few seconds on this here. So we are, as many of you know, have attended our webinars where we do try to get guest speakers on various different subjects, and January will be no exception. We ourselves are kind of a one-trick pony. It's IC Disc all day, every day at Quantitax. We work with all sizes of accounting firms, including some of the country's biggest, as well as local, regional, even some sole practitioners in cases, to help their clients and to help companies directly with maximizing and identifying IC Disc benefits. Today's focus will be a lot about the often overlooked scenarios that we see, as well as some background and beginner kind of stuff on IC Disc and how the incentive is structured and all those types of things. But our firm is basically ex-PwC folks, and we do have proprietary software to help maximize the benefit. We'll talk a touch about that at the end of today's presentation, but that'll really be tomorrow's focus, is how you can get much more out of the benefit. That'll be tomorrow's CPE program than most people realize. We see it in print many places, many articles where so-called experts have proclaimed that you can only get a certain amount of IC Disc benefit, a certain amount of sales, or a certain amount of taxable income, and that's just very wrong. It's as wrong as saying that that the maximum amount of standard deduction you can get on a 1040, or the maximum amount of deduction you can get is the standard deduction, as opposed to itemized deductions, if the itemized are more. But forgive them, they know not what they speak of, I guess. All right, so what is the IC Disc? For those that are newer to the incentive, those that are not as familiar with the IC Disc, what does it stand for? First of all, it's Interest Charge Domestic International Sales Corporation. So this incentive has been around in one form or the other since 1971, and the legislative intent of the DISC was to encourage foreign use of products and some services, but largely of products that are at least partially U.S. made or produced or recycled, destroyed even in some cases, that undergo some substantial transformation in the United States. And it's not really that important who does it, as we'll learn, but there does have to be some level of U.S. production, processing, assembly in the U.S., and foreign use of the goods. It provides a permanent and immediate tax benefit. It is an annual benefit, and the IC Disc in general has no effect on business operations. There are a few different ways to use the IC Disc, but the way I'd say 99.9% of the uses uses what's called a commission IC Disc, and that has absolutely no effect on business operations. The third thing in bold on this slide, so kind of our big three in terms of whether someone can benefit from the DISC or not, is that it's privately owned companies currently that can benefit. And generally, the benefit is going to be on the tax returns of the owners of privately owned companies. That's in the case of flow-throughs, S corps and partnerships, LLCs. But C corporations can benefit as well if they're privately owned. So again, our sort of big three in terms of identifying or measuring potential eligibility for having tax benefit from the IC Disc program is the three things that are in bold on this slide. Do you have products that have some foreign use, that are at least partially produced in the U.S., and is your company privately owned? So foreign use, partially U.S. made, privately owned. Those are sort of three big delimiters, if you will, or if we're doing a Venn diagram, like our last vice president, those would be the three things the circles would represent, and where those overlap, that's where we want to look at the potential for using an IC disk. Code sections, where the disk information is found for the most parts in 991 through 997, and the related Treasury regulations. Okay, so what does this incentive do in general? What does it accomplish for you? We know that it was put in place by Congress to encourage foreign use and U.S. production of products, but what does the incentive actually do for you? So it allows at least half of the net income from eligible activity of a private company to be taxed at the capital gains rate instead of the ordinary rate. So there can be a component of deferral, but in general, the incentive is going to allow in addition to that deferral, which may or may not be present, but what it's definitely going to do, the use of a commission IC disk is going to allow half of the income from the activity that was that we talked about in the last slide, foreign use, partially U.S. made for a privately held company. It's the incentive that allows at least half of that income to be taxed at the cap gains rate instead of the ordinary rate. So it is a permanent savings, not just a deferral, which potentially you can have a deferral, but it's a permanent savings, and it is an annual savings. So this is not this is a permanent part of the tax code. It's not something that's a one-time benefit. It allows you to every year get half of that net income and a minimum to be taxed at the lower tax bracket rate. So as we'll learn here, that's going to depend on what exactly the individual's rate is, where there's IC disk income. We'll see those mechanics in just a second here. So mistakenly, in many CPAs and companies, the thing that sticks in their head is that this only benefits owners of companies if they manufacture products themselves in the United States, and if they directly export them to foreign countries. So neither of those things is required, as we'll see in our examples today that focus on again, the overlooked benefits of the IC disk, because that's what we're talking about today. So again, this misconception is very widespread that, geez, I've got to make something in the U.S. and I've got to directly export it to a foreign country. Just as big, I would say, part of that misconception is that the products have to be sold for use in Canada. That Canada and Mexico does not qualify, and products sold to those countries are not considered use outside of the United States. Canada and Mexico absolutely do qualify. In many cases, we're so NAFTAized, or I guess now it's the USMCA, or Mexico-Canada Trade Agreement, NAFTA 2, as many call it, that we just assume that anything going to Canada and Mexico wouldn't qualify for a quote-unquote export incentive. But Canada and Mexico, uses in those countries, absolutely do qualify if products are expected to be used or ultimately consumed in those countries. Okay, let's talk a little bit about the legislative history of the IC disk and its predecessors, really. Going back, export incentives, well over 60 years old. Kennedy administration, I believe, started with this Western Hemisphere Trade Corporation. There was the original DISC, or Domestic International Sales Corporation, the Foreign Sales Corporation, ETI exclusion. So depending how much gray you have in your hair, you might recognize some of these incentives, especially the ETI exclusion, which was around till, I guess we're coming up on 20 years ago. But the common thread in these, and I just want to mention them, is that Congress has had incentives around that really didn't have much to them in the way of what they really required, much meat on the bone, but that were designed to reward U.S. companies for exporting or having products used abroad that were partially U.S. made. It was sort of a bit of a wink and a nod with some of these incentives, and including with the IC disc, because there is some formality to them, but the formality is designed to be able to be extremely easily satisfied. So the reason these different entities and incentives have been around and changed was due to complaints by our trade partners, the WTO, the EU, the GATT roundtable. They all had complained over the years that these incentives are, contrary to sort of a fair play rules and things like that in our trade agreements, and they didn't like the fact that we were, receiving these benefits, that U.S. companies would receive these benefits for exporting or being involved with a product that somebody else exported. Let's talk about the IC disc and how it works, which is similar to how some of the earlier incentives worked. Many call it a paper company or a shell company. I'd say that's fairly accurate, because the intent by Congress was certainly to have these benefits be available, but not require the IC disc, which is a separate entity, to do much of anything or anything at all. That was the explicit intent of Congress, was that you set up a entity, this interest charge domestic international sales corporation, allow it to receive a deductible commission from a related operating company, and it can serve as your export commission agent, but doesn't have to. Literally for nothing other than being set up and getting qualified as an IC disc, which is filling out a simple form. This entity does not have to do anything, and it's able to receive a commission, as we talked about earlier. That's at least half of the income from activities that are eligible. So, and then that tax exempt income is able to be returned as a dividend, which is taxed at the capital gain rate, or in some cases, and when we say return, sometimes it's returned to the operating company itself. In most cases, sometimes it's returned to the individuals that own the operating company. There's a couple different ways you can structure the IC disc, and we'll finish up our kind of basic discussion for those that are newer to the disc with some diagrams here on the couple different ways you can structure it. But on the last bullet point, we want to underscore the IC disc entity. It can have assets. It can have employees. It can actually take title to goods and export them. That would be an active IC disc. But again, 99% of discs that are out there are what we call commission discs. And again, they're able to receive a commission from a related operating company that exports, simply for existing as an IC disc, simply for filing the correct form and getting it approved by the IRS, and annually filing an 1120 IC disc. So again, we want to underscore partially produced products, process created in the U.S. What does that mean? Well, we'll go over the specific examples of what satisfies that, and that ties into why that's so often overlooked, because again, it's often assumed that products have to be manufactured from scratch in the U.S. and that only the manufacturer is able to benefit. But there is a production requirement, but as we'll learn, doesn't have to be the manufacturer alone. Even packaging and labeling can qualify for that as well. Even just packaging and labeling, there doesn't have to necessarily be manufacturing in the U.S. And that expected use abroad, which we talked about and led off with, including Canada and Mexico. It generally doesn't matter who sends the items abroad. So if I make a product, sell it to someone else, and they export it, in general, there are some limitations, but in general, we're both going to be able to enjoy the full IC disc benefit, not just the manufacturer, not just the exporter. Okay, so as we said, how does this work again? I mentioned that it doesn't have to do anything, and we keep underscoring that point because another large misconception I would say is that the IC disc has to export goods that are made in the U.S. And again, it doesn't really have to do anything but sit in the background and be an IC disc entity. Again, it returns tax-exempt income as a dividend to its shareholders, which oftentimes is the exporting company itself, and that is taxed at the capital gain rate, not at the ordinary rate in the case of individuals that own these privately held companies. Typically does not have any employees. It's just again able to receive that commission just for electing IC disc treatment. So let's look at our typical structure for the IC disc. Typical structure. We had a couple slides here repeated. I apologize. Typical structure for a flow-through entity. So a S corp, a partnership, an LLC agrees to be or elects to be taxed as a partnership. How does the IC disc work? Well, you have your individual owners up here. This would be your S corp or your partnership, this entity that is marked U.S. operating company here. Let's assume it's an S corp in this example. And again, our sort of our red arrow down here represents IC disc commission, again, that the operating company can pay to the disc for doing nothing, literally doing absolutely nothing but being set up as an IC disc. And again, this entity is tax exempt. Generally, it's going to be a tax exempt entity, so it receives a commission, whether it's $1, whether it's $1 billion, it doesn't matter. The IC disc receives a commission of let's call it $1 million in this example, and it immediately pays the dividend back to the operating company. So from the operating company's standpoint, it has exactly the same amount of income that it would have with or without the IC disc. It's generally going to have the same amount of income because whatever it pays out as a commission, it receives back as a dividend. Usually this is done within the same year, but there is potential to defer it. So in that case, the operating company's income might be the same over 2 years, but there might be you can potentially defer this dividend. But most cases we see an estimate paid back and forth in this scenario before the year end, and then sort of a journal entries, accounting entries to sort of adjust the amount that's transferred between what would actually be IC disc commission and dividend, again netting to zero, and then the overage, generally considered a intercompany loan that was settled the same day. So in a typical example, this is exactly how we'd see the funds moving. Typically in late November or December, might pay an estimated amount of commission and dividend back and forth between these two entities, and thus, from the standpoint of anyone that's looking at the operating company's books and records or tax provision, again, the income would be exactly the same. Well, what's the benefit in this example? Well, the benefit is that, of course, when this dividend comes back as a qualified dividend and flows through to the individual owners on their 1040s and on the tax return of the flow-through company as well, it's going to be qualified dividend income as opposed to ordinary income. So if there is a deduction of $1, there's a dividend of $1 that's paid back. Deduction of $1 million, then a dividend of $1 million will come back. So again, this isn't going to affect the income that flows through to the individual owners in the flow-through scenario. It is just going to affect the taxation on the individual owner's tax return. So said another way, the the Schedule K that would be that would reach the individual owner or owners would be exactly the same, but let's say without the IC disc, it might be $2 million. And let's say there's $1 million exchange between the operating company and the disc. Schedule Ks will still be $2 million that reach the individual owners, but now they'll, instead of 2 million of ordinary income, it's going to be $1 million of ordinary income and $1 million of dividend income that flows through to the owners. So that's how the benefit is achieved, again, on the 1040s of the owners of the operating companies in a flow-through example. Okay, so why would we schedule the disc as structure the disc as a subsidiary? And I'm going to skip ahead for 1 second. I'll come right back. But the other way that we can structure a disc besides as a subsidiary is, you see an operating company here again, but this time the IC disc is brother sister, and you can see it's would have to be owned by have common ownership with the operating company, but it would be brother sister, so the shareholders would own the disc directly, as you see here. One reason we would structure the disc in this manner is, let's say our operating company is not a flow-through entity. If it's not an S corp or partnership, but it's a privately owned C corporation. If that's the case, then the dividends received deduction rules would not allow this IC disc to be a subsidiary. I mean, you could set it up as a subsidiary, as we see on this slide, but paying a commission in this manner and a dividend back to a C corp would not help us because of the DRD rules. That dividend would not be expected because it's received by the parent company. So from a C corp standpoint, if your privately owned company is a C corp, you're going to have to make the IC disc a brother sister entity like this. So the C corporation, which is the operating company in this slide here, would be the would be the entity calculating and paying that commission, which again is at least half of the income from qualified activities. So there would be a immediate and permanent reduction of 21% because the C corp would be able to deduct this amount here to the IC disc, which would still be tax exempt. The IC disc would then pay it back to the shareholders of the operating company. And again, this could be the same shareholders, could be just a majority, but the dividend is taxed at 23.8%. So the benefit here is that if the C corp is in a position where it would otherwise be paying a dividend anyways, now we just make that dividend deductible. So again, for C corporations, we would definitely need this structure. The subsidiary structure would not create permanent tax savings, and we'll talk about a few other reasons why we might want to use this brother sister structure, even if there's a partnership involved. But let's go back to the typical flow through structure here, the structure for partnerships and for S corps that we typically see. So again, why would we use this flow through structure? Well, the advantage is with a subsidiary disc, there's no interest charge. When we talk about an IC disc, the IC, remember, in interest charge in IC disc is, interest charge, Domestic International Sales Corporation. So what that means is that if we have a mismatch in years between when this commission is paid and the dividend is paid back, because you are allowed to defer the dividend and you sort of receive a mulligan to do that without any penalty or charge in the first year, but anytime after that, anytime you've got 2 years in a row where the dividend has not been in the same year as the commission income, the tax-exempt commission income for the disc, there's going to be an interest charge levied and a separate form filed, Form 8404. And the thing about that form is it's not reported at the shareholder level. If you have, 50 shareholders of your of your operating company, S Corp. If your S Corp has 50 partners or 50 S Corp shareholders, each and every one of them has to file that 8404 form to disclose how much benefit was gained from the deferral. So generally not something that we recommend, especially the more widely held that your privately owned company is. The commission and the dividend remain in the same year. That's of great benefit, because if you've got, again, other parties looking at the commission and the dividend, whether it's estimate or whether it's been trued up already for the year, the great thing is that it's always going to sort of net to zero if you keep those estimates within the same year. So that's another good reason to use the flow through, or sorry, to use the subsidiary disc. No interest charge due to deferral. The commission dividend estimate remain in the same year. Those are great reasons. Consolidated basis financial statements will always be identical. So whether you have financial statements for this opco or for this opco and its subsidiary, they're generally going to be consolidated to be the same. As we talked about, the commission and dividend always net to zero. So those are great reasons to have a subsidiary disc. You are locked into, if you have the disc with this structure, you are locked into the dividend going to the individual owners in exact proportion to their ownership of the operating company. So that's one thing to consider. If you wanted to have differing ownership and have everyone agree on that, then we would be back at the brother-sister, again, structure, which we look at here, which again, we really need to have for C corporations, but we can have for, we can also have this for flow-throughs as well if we wanted to, for some reason, change the ownership to not be equal to what's going on in the partnership, whether this entity is a flow through or whether it's a C corporation. So if we look at the rules, or sorry, the reasons why we'd want to have the brother sister disc, again, for C corps we need it because it won't produce the arbitrage. Let's talk about this one. So it can reduce individual taxation compared to compensation for C Corp. So let's look back at our slide here, and assuming we have a C Corp, obviously we can get a deductible dividend out, as we talked about earlier, and that's great because we're not paying double taxation to the C Corp shareholders, and we're still getting a dividend out. But what about if we're in a situation where, and this is again on our theme of overlooked benefits of the IC disc, some C Corps, privately held ones that we look at, will say, well, geez, we just don't have much if any taxable income because we pay deductible bonuses out to key employees or owners, and we sort of manage our C Corp down to zero, so we don't really have dividends to pay out. Well, let's talk about that. If we're paying a deductible bonus, so let's assume it's going from the operating company right to the individual owners. If we're paying a bonus of, say, $1 million to one of the major owners of the C corporation, certainly it's deductible, just like an IC disc commission is deductible. You might be paying some withholdings on that you don't have to pay if you use an IC disc commission instead. But in general, they're both going to be deductible. But remember, when we pay a bonus from the operating company, say a discretionary bonus of $1 million to the owner of the operating company, they're going to pay tax on that at their top individual rates. So if they're in the top rates, on their individual rates. So if they're at the top rate, it's 37% is the marginal rate on that income. However, if we instead pay a deductible commission to the IC disc entity, let's say we are able to generate a commission of $500,000 So again, we want to get this owner of the C Corp $1 million, but we're able to generate a commission of 500,000 if we so choose to as an IC disc commission. We can still pay our owner 500,000 in bonus. The other 500,000, however, could be paid to the disc, so it'd be fully deductible, no withholdings, and so still the C Corp's in exactly the same shape, maybe even a little better with the avoiding the withholdings we talked about. The individual still gets that 500,000 question with our green arrow here as the disc dividend, but this is only taxed at a top rate of 20% plus the Obamacare tax, eligible net investment income tax. So on that 500,000, we have decreased the taxation, assuming this individual's in the top bracket, from 37% to 23.8%. So that's a savings of 500,000 times 13.2%. Individual savings and immediate and permanent tax savings. So again, for C corporations, reducing individual taxation for compensation by using the disc to the extent possible to substitute for what would otherwise be a discretionary bonus. The disc dividend, as we talked about, it's fully deductible from C Corp funds. Another reason to use sort of this brother-sister example, regardless of the form of the entity that we have, is to potentially accomplish some succession planning. So we have a lot of cases, especially with privately held C Corps, where matriarch or patriarch of a company might be sort of, become a consultant, enjoy their golden years in Florida and maybe get paid some compensation but not as much as in the past. So there's ways to where we could tilt the disc ownership so it would still be related to the operating company, which is required, but we could tilt the disc ownership further towards older generations and have them get money out of the disc in a very tax effective manner there, along with the compensation that we talked about. So that's another tool that's overlooked often, is using a disc or multiple discs for a C corporation or a flow through to get the compensation or funds that you want out of the disc. So we have many C corps that have done multiple IC discs. Let's say this operating company is owned 50-50 by a mother and daughter. Mother founded the company, daughter's become the CEO and is starting to be more active while the mother's becoming less active. Certainly, we could have a disc that is 50-50 owned by those two. We could have one that is, where the ownership is tilted towards the mother, and it has almost all the ownership, but it's still going to be a related party. So great things that we can do with structuring when there's succession planning or compensation substitution involved. And that again goes with this last bullet point, which is when we say variable dividends, what we mean is that we don't mean that we can decide on the dividends percentages. Dividends have to be paid to whoever the shareholders of the disc are in proportion to their ownership of the IC disc entity. But we can, again, either structure multiple discs to have different ownership and decide how much commission to pay through the different discs, or we can, what's kind of become in vogue is the structure we have here. But just imagine an LLC that is inserted here between the disc and the shareholders, and its sole purpose is to receive 100% of the disc dividends, and then it has a board of managers that decides year by year how much the shareholders of the disc would receive. So a couple of different ways that can be done, but again, the point is to accomplish variable dividends to operating companies that are doing the export, as opposed to being locked in to just 100%. Now, in many cases, again, this flow through the subsidiary works perfectly because again, it's just one owner, and we want all the dividends to go there and all the tax savings to go there, or it's two partners and we always want the savings to be 50-50. But those are, from a structuring standpoint, some of the things that are available, and they're often just completely overlooked. The worst thing I would say is when we see a flow through with just one owner set up with this sort of brother sister structure for no reason at all. So there's just a lot of complications when it could be done a lot easier with the subsidiary structure. But many times these are set up by general attorneys that can't turn down a $7,000 or $8,000 fee or whatever they charge for filing a disc election and doing the structuring, and they just have never heard of a subsidiary desk, so they go ahead and set it up as a brother sister for no good reason. Okay, so let's talk a little bit. We'll dive into the products and services that qualify, and we'll look at the rules in a little bit of detail and some of the overlooked scenarios. And again, the point for today's presentation is not to talk about all the various exceptions and the code sections that go with them, but rather to discuss in real world examples and scenarios that are often overlooked, just like in the structuring world or even eligibility for the disc. We've got a lot of overlooked opportunities that we've talked about thus far. So we get asked about services. We started with saying, products that are partially produced in the U.S., expected to have foreign use outside the U.S., and they're owned by privately held companies. Well, what about services? Are there services that can qualify? Services, unfortunately, very, very limited. One set of services are things that are what we call related and subsidiary services. We don't really have a slide for that, but that's as simple as if I, export a tractor that's made in the U.S., I export it to Belgium, but I also provide related and subsidiary services such as warranties or installation, things like that, within certain thresholds. Those related and subsidiary services can also qualify, but again, they've got to be related to a hard product. So you've got to have a tangible product that qualifies and that you claim IC disc benefits on, claim a generated IC disc commission from, in order to have those related and subsidiary services qualify. That's one category. The other category that's really missed very, very frequently is services that are architectural or engineering in nature. Very specific definition for what's A&E in nature, and it doesn't require to be licensed architects or engineers. In fact, the definition, though it's very specific, but it is very wide in terms of what could be considered architectural engineering services. There's generic language talking about specialized mathematical formulas used and things like that. So very taxpayer friendly rules for architectural and engineering, as we have seen in DPAD, and as we've seen with the 199A deduction that came in with the Trump tax cuts. They've always got to so they always have their special carve out for A&E services. So again, they've got to be A&E in nature, and so a two-pronged test here, related to a proposed or actual construction project outside the United States. So again, rules are very loose here. Anyone can do the work. You can use subcontractors. There's not the cumbersome rules that we see on the next slide for hard products, for tangible products. But again, for services to qualify, they've just got to be A&E in nature and related to a proposed or actual construction project outside the United States. Okay, so for hard products or for hard property, what are the rules? Why are they overlooked so often? And so there's a 4-prong test for property, and this test. So all of these tests must be met, and there are, in some cases, there are a few other regulations and more specific rules that can fall in. But the major 4 tests that if you have tangible property that meets these 4 tests, it's going to qualify, are listed here, and we'll go over them here, and then look at the examples on these with those real world scenarios I mentioned earlier. So there's got to be expected to be use outside the United States. There's some favorable exception. There's some cases where property might even be able to come back that we'll talk about. But in general, there's going to need to be expected use outside the U.S. So, in general, it's got to be used outside the U.S. for the 3 years following its shipment outside the United States, or ultimate consumption or disposition outside the U.S. So we've got expected use outside the U.S., but there doesn't have to be explicit exporting by a party looking to claim an IC disc commission or generate an IC disc commission. Okay, no more than 50% of the sales price can be foreign content. This is often confused. People think it's 50% of the cost of goods sold. Absolutely not. So this rule is as simple as if the product is sold by me or someone else for $1, I'm only allowed to have 50 cents of raw, unadulterated foreign materials in the product. I'm only allowed to have 50% of the sales price in there. So if we knew just these first 2 rules, right, there's got to be expected foreign use and no more than 50% of the sale price can be foreign content. But one would think, well, geez, we can, import a box of goods from China that are fully made in China for $1. We can export them as is to Canada for $3, and we'll have met both these tests because there's expected use in Canada, and we sold for $3, but our cost, which was all foreign content, was only $1, so we're only at 33% foreign content. Certainly, importing foreign-made items and just exporting them as is would certainly meet these first 2 tests. But remember, Congress wanted to incentivize more than just exporting. They wanted to incentivize some level of U.S. production to the product. Doesn't mean it has to be made from scratch, but there does have to be some level of substantial transformation in the United States. So one of the big confusions or misconceptions that we see is that people think that this partial U.S. production has to be done by the taxpayer. That's not true. It has to be done in the U.S., but not by the taxpayer. Secondly, of course, reasonable people could disagree on, is something just, light assembly, or does it rise to the level of, manufacturing or substantial transformation? Well, thankfully, Congress put in this sort of optional safe harbor. And again, you can substantially transform something without meeting the safe harbor, but they did put in this optional safe harbor, which is the second sentence in our slide here, which says that if 20% of the total cost of goods sold, not the sales price this time, but the total cost of goods sold, are attributable to U.S. labor and factory burden, and again, that includes packaging and assembly specifically, then it automatically passes this test. So again, even if something I bring into the United States is wholly produced outside the U.S., but if the amount of U.S. labor and burden that I put into producing the product, or labor or packaging and assembly, I would automatically pass this test. So point being here, even just packaging and assembly alone, if our U.S. labor cost is enough, we're automatically going to pass this test. And lastly, the product can't be further manufactured by another party inside the United States before it leaves the U.S. It can't qualify in that case for the first party. So if I sell a finished product to Ivan that's made in Ohio, whether I make it or not, sell it to Ivan in New York, if he doesn't substantially transform it, but he just adds maybe some packaging and even just stamps his name on it, Ivan's a distributor and he exports it, In that case, we're both able to claim the IC disc benefit. But however, let's say I send, raw metal to Ivan. He then turns it into screws and bolts in New York and then exports it, and it turns it into nuts and bolts and fasteners and whatever else. Then he's certainly eligible to claim the benefit, because he's the last manufacturer. But unfortunately, as the person who sold him the raw metal, I'm not going to be able to qualify. So, we see this one overlooked a lot too. Not all of the things that are misconstrued on the IC disc are positives. Sometimes we do find folks that are not producing their products or selling products that are produced in accordance with these rules or meeting these rules. And there's some bad news on the overlooked sort of knowledge front as well on the disc sometimes. So let's talk about some industries where these rules are overlooked, very, very frequently. So it doesn't have to be a physical product, but software that has some level of production, substantial production in the United States, video games, content, articles that are edited or written in the United States. Those are things that can be used abroad and can claim disc benefits on. Distributors and brokers, again, people will ask, well, isn't this double dipping if I make something, sell it to Ivan, and he exports it, and isn't it double dipping? Not as long as we're not related parties. So because both of our benefit is ultimately going to be limited by the taxable income on our own taxable income. So that is not double dipping. So distributors, brokers, even if they never touch the product, but they do have title to it, even if it's just a flash title transfer. We see many brokers that don't realize they're able to claim disc benefit. Sales of property that's just used abroad, even if there's no export sale. We'll go through some examples of that. So there does not have to be a foreign customer. Yes, there has to be expected foreign use, but there does not have to be a foreign customer. Food growers and processors, so it's not just manufactured products, manufactured, produced, grown, or extracted in the United States. Offshore drilling, that is conducted outside of the nautical borders of the United States in international waters. That's outside the U.S. Satellites, outer space, equipment leasing. So it's not just sales of property with expected foreign use. It's leases can qualify as well too. Recycling, huge industry that we see largely because many recyclers are taking apart items and they are extracting materials that are in demand abroad. So they're exporting. There's a lot of exporting going on there. A&E services, again, when something's thought of as a manufacturer's incentive, we don't see the A&E services picked up all the time. Cruise ships, that's a very interesting one there. Again, operating in international waters, if the property that they're using meets all the other tests and it's consumed outside the United States or used outside the U.S. in those territorial waters or international waters. Vehicles, there are special rules for vehicles. So it's not just, let's say you're making an aircraft in the U.S., it's not just, sort of a one-time delivery to a foreign airline. It could be used by a domestic airline, but if the miles traveled by the aircraft are expected to be more than 50% international in the 3 years following the delivery of the aircraft, that can qualify. Containers, pallets, bracing, that's another one we're seeing a lot of. Materials used for transportation purposes. So not just vehicles, but things like, ocean-going freight containers as well. Those same, expected use rules would apply. Used and refurbished equipment. So oftentimes we see foreign equipment that wholly made outside the United States was then used in the U.S. for, a number of years. So certainly, wouldn't pass our foreign content test number 2 on this slide here. But if it's used equipment, then it gets refurbished, and there's enough, even if you consider it 100% foreign content to start with, but if the amount that goes into the refurbishing is significant enough to get you over that hurdle of our production test, then absolutely used in refurbished equipment that's then subsequently exported or used outside the U.S. can qualify. Components that are further manufactured abroad. This is maybe the number one overlooked scenario that we see, is components that go outside the U.S. to be incorporated into a product, oftentimes by a U.S. company. And as we'll learn in the examples that we finish up with, oftentimes can come back to the United States and still be considered eligible for DIS purposes, believe it or not. And then there's clothing and fashion accessories as well. We're seeing, again, they may be produced outside the U.S. but emblazoned in the U.S. and that's before they're sent to Canada or Mexico. So we're seeing a lot of that. So we're going to finish up by looking at some real world examples and talking about some examples where the DIS benefits apply here and where they're often missed. So distributors, we talked about this in this example. A furniture maker produces and sells domestically, but they also have a distributor that sells internationally for them. So if they're unrelated parties, both of them can claim the DIS benefits. And oftentimes people ask, well, how is the distributor going to know if they're carrying tons of products? How are they going to know whether the furniture met the content and the production rules that we went over earlier? How are they going to know that? Well, oftentimes there's a sort of one hand washes the other scenario here, where the distributor informs the producer the percentage of products that were used outside the U.S., and then the producer tells the distributor that yes, we meet these rules, and so they kind of exchange emails every year where again one hand sort of washes the other by providing the information needed for the other party to benefit. There's some other ways that can be satisfied as well that we'll go through here that don't require any discussion between the parties. Okay, so we talked about, I mentioned component makers. And so this is, again, probably the most overlooked scenario that we see. And in this case, a company makes automotive components in Cleveland, Ohio. They ship them to Ford Motor in Laredo, Texas. Ford installs the components into cars in Mexico. So looking at the scenario in blue here, a company that provides these components or their outside CPA, generally, if they do think about IC disc, they would think, well, geez, we are making these components in the U.S., but we're selling them to a U.S. company, not exporting them, which doesn't matter. We're shipping them to Laredo, Texas, which is customs stopping point. They're going on to Mexico. So again, the fact you only ship them as far as Laredo and you sell it to Ford has no bearing at all on the qualification. And furthermore, they're probably thinking, well, geez, these components are installed into cars in Mexico. They're very well likely going to come back to the U.S. How could this possibly qualify for an export incentive? Well, there are component-friendly specific regulations that lay out this exact scenario. And as long as the final product that the components are being installed into, a car in this case, something that's used on the world market, then as long as the component maker in Cleveland is not informed of the percentage that return to the U.S. versus go to Latin America versus go to Canada, as long as they're not informed of that, or they're party to some agreement or memorandum of understanding that would tell them that knowledge, give them that knowledge, then they are 100% absolutely allowed to claim the benefits in this scenario. So that's definitely one to look out for with specialty manufacturers, especially if they're making component parts. Okay, software. Let's talk about software. So the IRS, even though it's riddled with errors in other areas, and you can't cite it as precedent, but just to give you an idea of where the IRS is kind of standing on issues, we like to look at their audit guides sometimes in certain cases, and they made it very clear that they believe that downloads of software, licenses of software, qualify. So in this example, um, we've got software that's partly developed in India, partly in Chicago, and it's licensed again to a U.S. customer that has users all around the world that download it. Let's say it's environmental compliance software that's used all over the world by GE. So if the software, again, if it's substantially produced in the United States, and we can't really rely on our 20% cost of goods sold safe harbor that we discussed earlier, right? Because generally you're not having cost of goods sold with software. But if the program is substantially produced in the US, maybe there's original conception of the software in the US, and then some nuts and bolts repetitive coding is done in India, and then there's final review in the U.S. before it's downloaded by users. Maybe that's substantial production in the United States. Again, the fact that we have a U.S. customer doesn't matter. And what's great here is there's no consorting between GE and the software developer. In this case, it's needed really because generally they're going to have the IP address of where the users are downloading the software and continual updates. Aftermarket parts. So, in our earlier example with furniture, it was, fairly big ticket, tangible item. And there's a lot of big ticket tangible items certainly that are exported, and where there's a distributor or there's just another party that might incorporate that item into a kit, so it doesn't further manufacture it, turn it from metal into nuts and bolts, but does some assembly or inclusion in a kit or something like that. But what about when they're smaller items? What about when they're items that are tiny pieces, parts, low cost, high volume? Distributor might carry thousands of different suppliers materials. So how are they going to know in that case? How is the distributor that's selling all those air aircraft parts or automotive parts or any other type of uh, items that are they're going to export some of them? How are they going to know whether those rules about production and content are met? Well, oftentimes because of our USMCA, our NAFTA too, if you will, there are um, there are country of manufacture standards that might be used, and we have some of our clients in our experience, especially that have smaller parts, they might ask their suppliers for a California um, production standard, which is actually much more stringent than the disc rule. So we're comfortable that if there's a California um, manufacturer designation that is that the supplier or producer is vouching for, that you've got a production and content in the U.S. because it supersedes those. There may just be a simple country of production. You pick up almost any retail product, whether it's Tylenol or a stapler or a phone or anything. There's often there's a country of origin there. We went through this recently with baseball cards, actually, that have a huge foreign market, and tracing where they were produced. But point being, that information oftentimes is there. It's just the distributor doesn't really need to look at it, or hasn't had a occasion to look at it. But many times that information is available, just not utilized. Okay, A&E services. So um, again, we want to underscore the fact that they're totally separate rules for A&E. Now, all of that stuff about U.S. production and labor and all that stuff doesn't mean anything for A&E services. They just have to be, again, either architectural or engineering in nature, and they have to be related to a proposed or actual foreign construction project. So in this example, we've got an engineering firm that does impact studies, environmental impact studies on remodeling Burger King restaurants in Europe. They don't end up winning the work. The project never goes through, but the firm billed for it. And by the way, I should add, it doesn't matter if they did the work with US engineers, if they hired subcontractors in Europe to do it. None of that makes any difference, but they did have revenue for studies that were A/E in nature and that were related, that were proposed for a foreign construction project. So one of my favorite examples here, a real world one, the client that we had that did a Ferrari themed theme park in Dubai, and they did all the landscape architecture plans for that. Never left Columbus, Ohio, and they did bill for that. The project was put on hold for many years. I think ultimately it was built, but it was discontinued, and they were able to claim those benefits explicitly because they met the architectural and engineering requirements. Okay, packaging. So we talked about earlier that safe harbor, right? If 20% or more of the total cost of goods sold are attributable to U.S. labor and factory burden, including packaging and assembly, then it's we're automatically considered to have met the U.S. production or partial production test. I'm going to go back real quick to that slide for a second. Again, that's number 3 here, where we've got at least some production level of production in the U.S. required. Doesn't mean that we meet these other tests. They still have to be met independently, but this one here, if you're just packaging something, you're probably going to think that you're not meeting a production test. So let's go through this example here where we're doing just packaging. So in this case, a company is selling picture frames, and every bit of material is foreign, right? The frame itself manufactured in Mexico, imported into the U.S. The wrapping is made in China. So there's no material that is produced in the United States. But the frames are wrapped, labeled, and boxed in Memphis, and then they're exported. So the wrapping and packaging in the U.S. may be enough to meet that made in the U.S. or partial U.S. production standard. So let's say the total cost of materials in this case, the Mexican picture frames and the Chinese wrapping, is $5. Let's say the amount that the company spends in the packaging process and boxing process is let's say it's $2. So we've got a total cost of goods sold of $7 in this example. So $7 are total cost of goods sold per unit. 20% of that is $1.40. We've clearly exceeded that with $2 worth of packaging costs. So we will have met that test. And, as far as qualification, we'll have it's considered produced in the U.S. solely by packaging and labeling. Now, remember, our foreign materials landed were still $5. So we do still have to sell the product for more than $10, right? Because we can only have only 50% of our sales price is allowed to be foreign content. But again, that you can beat with just markup. So as long as they sold for more than $10 and it is destined for use outside the U.S. and nobody else is further manufacturing that picture frame before it leaves the U.S., we'll have met our 4 major tests and have qualified there. Okay, so we've kind of gone through the rules. Hopefully, talked about some areas where you may not have thought that IC disc would apply or that how it could be used, and that it would be able to generate more benefits than you might have thought, or apply to a situation that you thought it would not apply to. We'll just finish up these last few minutes with a little bit of discussion of, again, something that's fits in because it's often overlooked, but it's more of a preview for tomorrow's discussion on our CPE tomorrow, which is increasing the benefits beyond just that half of the net taxable income from the products that qualify for IC disc. So when we calculate the benefit or we calculate the amount of disc commission, half of the net taxable income. We've seen that in many cases, many articles that you might find on IC disc telling you that the maximum amount of commission that you can get, the maximum amount of commission that an operating company can pay its disc, our red arrow here, is either 4% of the export sales or 50% of the taxable income, which is what we've been using when we've referred to that in this presentation. Even though that's online at probably 100 different places, those are not the maximum amounts of commission you can claim. I would actually look at those more as the minimums. There are a whole set of other rules that allow you to claim and encourage you to claim more of an IC disc commission based on the profitability of individual transactions. So you can look at them. You can use either the 4% or the 50% method I just alluded to for each transactions, as well as there are 6 other methods that allow you to look at the relative profitability of what you're exporting and to generate a higher commission than just the 4% or the 50%. So are we at polling time, Ivan, after PDF slide 22, or is that 23?
After 23, but I can launch it now just because we're so close.
We can go ahead. Yeah, why don't we launch it? So while Ivan is launching that, let's take a look here. This is just a real world example of where those 2 basic methods, if you can see down here in red, those 2 basic methods, again, 50% of the income or 4% of the sales, generate either 125,000 or 250,000 of IC disc commission. But by using all the different methods, this high-level summary shows us that we were able to increase the commission by over $1 million in this example. So that was with the tax rates for this taxpayer, and in that tax year, that was 170,000 of additional cash savings, immediate and permanent cash savings. So just a little, teaser for tomorrow is going into these rules and how you can get much more than 4% or 50%, and how that's explicitly shown in not only the compliance forms and laid out in the regulations, but is often overlooked. And we'll sort of finish up on that note by saying, this detailed IC disc analysis that we're going to go into tomorrow, and how you can get so much more commission. Most form Schedule P. So think of this as like on a 1040, you've got a Schedule A, right? You can't just take a home mortgage deduction and charitable deductions without having a Schedule A, right? You might not need to turn in all your certain level of documentation, but you've got at a minimum have a Schedule A. Similarly, this is a required form with the 1120 IC disc. Even though it's a tax-exempt return, you've still got to report how you calculate your IC disc commission. So you can either check this box, group of transactions, and then you can take the 50% of the income related to all of your IC disc eligible transactions in aggregate, or 4% as we talked about, or you can use those other methods and you can check this other box, single transaction. So if you've got hundreds of thousands of export transactions, guess what? You actually need hundreds of thousands of this form to be produced to be in compliance. So there's definitely got to be software in play that, if for nothing else, produces the right compliance. And I guess we'll go ahead and finish up there for today. Appreciate everyone's time today. Thank you very much for joining us. Thank you so much.